Nike Inc. ticker symbol NKE is currently trading at $89.44 a share. Over the last year, this stock is actually down around about 6%. You can see it was trading at highs around about 120 and then lows of around about 70 and has rebounded relatively strongly in the last few months. So is this the right time to buy? That is the question we're going to answer today. So let's have a look at my automated stock valuation spreadsheet, where we'll look at all the latest company financials, then seeing if there's a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and of course the Graham formula for intrinsic value. So let's have a look here. We have all the latest company financials here. I've just entered in the ticker beforehand, and you can see it's loaded them up. So currently has a market cap of 134 billion, a PE ratio of 24, which is lower than the market average of 29.9. Earnings per share $3.73, a beta of 1.02, meaning it is just about as volatile as the market, only slightly more. And analysts do think it is a buy with a target price of $92.69. A favorite for dividend investors, potentially with its 1.56 dividend yield, meaning that will net you $1.48 a share. It is a very safe dividend with 1.8 billion. Payout ratio is around about 30%. Now, if we have a look at the ex-dividend date for Nike, if we go here, so the previous date, unfortunately, was the 3rd of September. So if you bought those shares, you would have paid that quarterly dividend of 37 cents. Forecast on this is looking that it will be around about the 2nd of December. So buy your shares before then if you would like them. So let's have a look at the revenue. Revenue is currently 51.43 billion, about the all-time highs, as you can see. In fact, it's the exact which was the number in 2023. So revenue has stagnated these last 2 years. Consistently, Nike revenue has grown apart from the pandemic year of 2020. They only dropped down a little bit. They have consistently grown, and between 2023 and 2024, it has been flat, and also in the trailing 12 months. So revenue growth has slowed, which is probably why investors are not too happy at the minute with this negative sentiment. Net income, similar story, 5.7 billion, just shy of its all-time highs of 6.05, up from 2023 and the same as 2024. But once again, you can see Nike consistently grew. They did have a few down years in 18 and 20, but then have been pretty strong since then. Free cash flow, different story. They are generating good amounts of free cash flow, 6.26 billion. Shares outstanding, they are buying back their shares. You can see they have had a consistent buyback program basically all the time. Now, there's been some splits in here, which is why these numbers are not exactly correct. But you can see Nike have consistently bought back shares as a way to reward shareholders. Assets versus liabilities. More assets and liabilities. The only year was during the pandemic year. We can see here that they've had consistently more assets versus liabilities. Now let's get into the discounted free cash flow model. This is a way of valuing companies based on their discounted free cash flow and looking at the cash flows to give a value based on their projected future free cash flows. Now it does have a value here. We're not able to calculate the weighted average cost of capital for Nike. So what we'll do is I usually put in about, we'll put in 8.5. We'll just override it there. So based on averages, that gives us around about $70 a share in value. Now let's have a look at these numbers and see if we agree with them. First, revenue, we are estimating about 6%, 54.5 and 57.8 billion in the coming years. Let's see what analysts are recommending. They actually expect lower growth. What are they expecting over the next 5 years? So actually, analysts are expecting lower growth, but they're expecting about 5.3% per annum over the next 5 years. So 6% might be on the high side, but I think that's what I'm going with. Net income margins, I'm happy with this as an average. You can see it's pretty consistent, although it has decreased in the most recent years. And free cash flow to net income, what we'll do is we'll take an average of these 4 values, which gives us 82%, 82.5%. And then that gives us a $80 stock. So discounted free cash flow model says the stock is not a buy, actually just slightly overvalued, which is quite interesting to see. Next, we'll have a look at the well, you can actually say if you're interested in this sheet, please look at my Patreon. Links are in the description. We will look at the dividend discount model. Now, unfortunately, with the WACC being out as well, we normally use a discount rate of around about 8% we'll use here, and intrinsic value $44 a share. So dividend discount model does not like the stock, although their growth is pretty, oh sorry, the growth number's wrong here, my mistake. 10.86. Yeah, that's still, yeah, it doesn't like it basically. So they do pay a dividend, but I would not worry about this too much. This model doesn't seem to like this at all, but interesting that it doesn't. Okay, let's have a look at the Ben Graham formula for intrinsic value. This is a formula created by Ben Graham, who is the godfather of value investing. This looks at earnings per share, PE of non-growth companies, corporate bonds, and current AAA bonds. Current AAA bond yield is around about 4.87%. I don't think Ben Graham's going to like this stock one bit. $45, and that's with a 5% growth. And I believe we saw that Nike was a 5.35%. So no, $46 stock. So dividend discount model doesn't like it at all, gives it a negative intrinsic value. Ben Graham gives it about 46, and the discounted free cash flow model did put it around about 80. But lastly, I would like to look at the comparable company model, which is a way of valuing stocks looking at companies of similar size, businesses, to see if it is a buy or a sell. So let's have a look at some here. Firstly, we'll do ticker symbol UA, which I believe is Under Armour. We will look at Crocs, ticker symbol Crocs, and SKX. Can we look at these? So what this will do is it will Skechers. What this will do is it will load all the company's financial data for these other companies, and we can have a comparison. So the problem is with these is because Nike is so much bigger than these companies, you can see the enterprise value and the revenue is almost 10 times higher than some of these. 130 billion compared to Crocs and Skechers, which are 10, and Under Armour is less than that. Revenue 51 billion compared to these as well. Growth rate is actually higher than Under Armour despite its lesser size. What I'll do here, because the PE ratio for Under Armour it is not displaying because they're not profitable in their most recent one. So what I will do is I will put Skechers here, SKX, and Under Armour here, and then we will do the breakdown, and I'll remove Under Armour from there because they will not like it in terms of PE ratio. 5-year growth, obviously we said Nike is third with a 6% growth compared to Skechers 12 and Crocs 28. Wow, Crocs is very high. We might have to look at that in a later video. Net income all profitable, obviously Nike with 5.7 billion. Higher profit margins than Skechers and obviously Under Armour, not as much as Crocs with 20.6%. Price to sales, price to book, highest in price to sales, and highest in price to book as well. Now PEG ratio, which is Peter Lynch's formula for price to earnings growth, puts Nike at 3.27, which is the second highest. Skechers almost on the undervalued scale here. So now we have EV to revenue, EV to EBITDA, and PE. Nike has the highest PE, second highest EV to EBITDA, and highest EV to revenue. So I don't think it's going to be a buy here as well. Obviously, Under Armour does not have a PE. So what we'll do is we'll just take that out the equation. And it puts it sort of anywhere between a $100 stock and an $80 stock. $60 stock, which gives it an implied value of around about 80. So discounted free cash flow and comparable company model, both saying it is slightly overvalued at the minute. So quite interesting. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already, and check out my Patreon, and I'll catch you guys next time.